January 2023. A series of tech crackdowns has been initiated by the US government against China after crucial technologies were once again leaked abroad. Major companies such as Huawei and Alibaba have found it especially difficult to navigate the current state of the world market, which is further exacerbated by the ongoing civil unrest and China's recent investigations towards monopoly and antitrust laws. Alibaba, China's largest e-commerce giant that has lost more than 40% of its stock value in the past 5 years, despite accounting for 58% of all retail e-commerce sales in China. Yet, despite Alibaba's market dominance and its recent stock dip, what does Alibaba's future prospects look like in a highly volatile market? More specifically, is Alibaba's stock a good investment? In April of 2021, Alibaba Group was fined 2.8 billion yuan or $426 million by China's State Administration for Market Regulation for monopolistic practices, something that is considered anti-competitive and therefore illegal. Accusations arose that the firm has allegedly been abusing their dominance in the e-commerce market to restrict competition, most notably coercing merchants into signing contracts that restricted them from selling their products on e-commerce sites run by their competitors. This was deemed detrimental to consumers by the SAMR and resulted in the single largest antitrust fine in China's history. Many see this as the start of China's new restrictions aimed to limit the influence of major tech companies over the population. Alibaba has since apologized and openly admitted to their unlawful law practices, and the company has sought to maintain its public image in the eyes of the Chinese population to prevent further losses. Fast forwarding to 2023, investors have some very mixed feelings about Alibaba's latest earning reports. Revenue grew 3.23% to $207.1 billion, while operating income shot up from 67.1% to $25.14 billion year on year. However, both net income and net profit margins showed a near 500% decrease respectively. The earnings call on September of 2022 further missed analysts' EPS estimates by over 86%, causing many to question the resilience of the Chinese giant. Luckily, it seems that the worst of China's tech crackdowns is over, paired with Alibaba's dominance in the e-commerce industry, which is projected to reach $6.39 trillion by 2027 at a compounded annual growth rate of 9.3%. Alibaba has cemented a strong foundation for growth and is continuously supported by new customers around the world. The firm has been expanding into parts of Southeast Asia and Europe through acquisitions, aiming to diversify its incoming source and build up its resilience. Alibaba is also exploring high lucrative fields such as cloud computing and digital advertising to expand their services past the e-commerce bubble. In addition to the firm's powerful partnerships with major Chinese firms such as Tencent and the Ant Group, Alibaba's future prospects look promising, assuming that they're able to recover from the myriad of new restrictions imposed by the US and Chinese government. On January 30th, rumors arose that the firm may be looking to relocate their headquarters to Singapore, but this was promptly denied by Alibaba themselves. However, it is safe to say that Alibaba is doing all that it can to provide investors with adequate returns and keep the company afloat. With the firm's continuous expansion into new markets and flourishing industries, the biggest factor against Alibaba's growth seems to be on the legal side. The future remains shrouded, but overall, we give Alibaba a hold for the short to medium term and a buy for the long term. With the highly anticipated Cybertruck coming out in the near future, Tesla stock seems to be in a prime position to bounce back from its recent catastrophic stock slump. Check out this video for more information. Thank you for watching, and please like and subscribe for more videos.